welcome to our webinar. Thank you for joining us today. We're going to talk about Roth conversion tips and other year-end strategies. My name is Larissa Greene, and please feel free as we go through the webinar to ask any questions that you might have. I'm going to be taking questions throughout the webinar through the question box. So we do keep everybody muted, but I'll be checking the question box periodically, and I'm happy to answer any questions you might have. The other thing I wanted to let you know is that I do have these slides in the handout box. So if you go to your navigator, usually along the right-hand side of the screen, you're going to see the question box there and also the section for handouts, and the slides are added there for you to download and review later. As I mentioned, my name is Larissa Greene. I've been with Advanta IRA for about 12 years now, since 2011. And I started out doing things like opening new accounts, helping with transfers, handling transactions for clients, receiving checks, helping pay expenses on behalf of an IRA. And I moved over in about 2013 to business development, education, and really just networking for Advanta. It's been something that I've really enjoyed, and I've learned a lot over the years, and I'm happy to share some of what I learned today with you when we're talking about the end of the year. So as we all know, as we get to the end of the year, it does just seem to fly by. So we're going to talk about things that we need to pay attention to for our IRAs, our Roth conversions, and anything else that we have coming up. Advanta IRA has been in business for just a little over 20 years now, and we have two offices. We're in the Tampa Bay area of Florida, and we're also in Atlanta, Georgia, but we can help people nationwide and even worldwide that have US-based retirement accounts. So if you have an IRA, an ESA, and HSA, and we'll talk about all of that in just a few minutes, then we can help you self-direct those accounts. Again, your retirement accounts just have to be US-based. We have over $2 billion in assets under management. And we also, something that we do a little bit different than our competitors is we provide every Advanta IRA client with a dedicated account manager who is with them for the life of the account. And the benefit, of course, there is you have the opportunity to reach out to that person when you have questions on anything, not just your transactions or getting an expense paid, but any questions you have on a self-directed IRA, you have that individual's contact information and email address so that you can reach out to them at any time with questions. And I think that really helps us stand out among our competitors. We are going to talk today a lot about IRS rules and deadlines and strategies that the IRS allows, but just keep in mind that we don't provide investment, tax, or legal advice. We have some professionals that do help our clients from time to time. So if you do need a referral for an attorney or an accountant, financial advisor, we'd be happy to provide that to you. But just remember that this webinar is for educational purposes. I'm not going to be going over specific scenarios today. So if you are looking for a professional that can assist you with some specific personal information, I'm happy to share contact information with you on some professionals that can help. So we're going to jump right into the webinar, and I see a few people joined a little late, so I just wanted to reiterate that we're taking questions throughout the webinar today, so please feel free to get your questions typed into the chat box or question box, and also the slides are added as handouts for you. If you check out the handout section of your navigation, you'll see those added there as a PDF. So we're going to start with establishing accounts and annual contributions. I know in the title, it really seems like we should be starting with Roth conversions, but I wanted to start here because I feel like this is sort of the precursor for Roth conversion strategies that we'll talk about in just a few moments. So I mentioned a few of the plans at the top of the webinar that can be self-directed. So more specifically, here's the list. And actually, if it ends in IRA, it can be self-directed. We're going to be talking about contribution limits for all of these plans today and their deadlines. And so I think that's important. A lot of times we talk about how we add the handouts for everybody to download, but this is going to be a great handout for you to have because it's going to give you those specific dates. So if you're looking at dates for contributions and types of plans, you're going to have it all there in the handout for you. So traditional and Roth IRAs are the most common IRA accounts that we see. Traditional probably because of rollovers from former employer plans as you see them listed here. And then Roth IRAs simply because these are accounts for individuals. So as long as you have earned income, you can make contributions to these accounts. We also have employer-based plans here, SEP IRAs, simple IRAs, and of course solo 401ks. And then we also have education savings accounts and health savings accounts available with Advanta, and we'll talk about contribution deadlines for those in amounts as well. So here, this slide is going to be very important for you because it really sort of summarizes what we're going to talk about here, but it's the 2023 contribution limits and deadlines. Not all of the accounts get an increase in contribution limits every year, but several of them did have contribution limit increases for 2023, and the employer plans do always get an increase for the following year. So for 2023, traditional and Roth IRAs are at $6,500 or $7,500 if you're over the age of 50. They call that a catch-up contribution. You're going to see that with some accounts, but not all accounts allow for an age difference catch-up contribution. Now, there are going to be some things that the Secure Act 2.0 changed for contributions. I'm not going to go into that too much today, but if you have specific questions on that, we can of course go over that on an individual basis, but when and how you make your contributions over the age of 50 for some of the accounts, that will depend on some rules with the Secure Act 2.0 changes. So SEP IRA contributions went up to $66,000 this year. I'll talk more specifically about how that contribution calculation works. You can see simple IRAs also did receive an increase, as well as 401ks. Education savings accounts, we call them ESAs. They're sometimes called Coverdell education savings accounts or CSAs. They did not get an increase on contribution limits, and they haven't for as long as I can remember. Hopefully that'll be something that will get an increase at some point, but currently it's still just $2,000 per year per child. And then health savings accounts, and I do feel like these go up every year as well, but you have your individual health savings account as well as your family plan. So let's look at these individually more specifically. So traditional and Roth IRA contributions did go up to $6,500, again, $7,500 if you're over the age of 50. Remember that your traditional and Roth contributions are total per person. So even if you have a Roth and a traditional, or you have several Roth accounts, your contribution limit is going to be $6,500 per person across the board. And so you can, contribute some to a traditional and some to a Roth, but the total cannot exceed that $6,500. You can open your traditional and Roth IRAs all the way up until tax filing, but not including extensions. And this is very important because sometimes people will reach out to us after the April 15th deadline and say, I still want to make my previous year contribution, and I did file an extension on my taxes. And unfortunately, at that point, it's too late. Traditional and Roth IRAs do not allow for extension filing in your taxes. Your contribution still has to be made by April 15th of 2024 for your 2023 tax year. So that's very, very important. You can still open and fund a traditional or Roth IRA up until April 15th of 2024. You just want to make sure that when you're thinking about opening an account, try not to wait until the last minute. It's important to understand that the deadline for contributions does not give you an exception for a bounce check or a check lost in the mail, wires not received. It's pretty common when people send a wire to, enter a digit incorrectly or what have you, and the wire doesn't go through. And if you called us on April 16th and said, I sent it yesterday, but then realized I typed in the account number incorrectly, unfortunately, there's no exception for that. So please keep that in mind as we approach these deadlines. Make sure you're working with plenty of time for errors, because they definitely do happen. I had a question pop up. Am I going to be going over conversions? I am going to be going over conversions. Yes, I just wanted to start here with account openings because it sort of seems like, a good way to get started, sort of the beginning, and then we'll talk about Roth conversions and a few other things that are important for year-end planning. So next we're going to talk about SEP IRAs, and these are employer-based plans. So if you're self-employed, you do not have to have a formal entity set up for your business. You can be simply a sole proprietor, but you do have to have self-employment income. Sometimes investors will ask me about passive income. The passive income that you receive does not count towards your SEP IRA contribution calculations. It must be earned income, something you're paying self-employment tax on. So please just keep that in mind when you're looking at something like a SEP IRA. A SEP IRA is a great account for employers. It's simple to administer. Advanta IRA handles all your tax filing for the SEP IRA. And you can make your contribution for your business up until tax filing plus extensions. So different than the traditional and Roth IRA that did not include extensions, you can open your SEP IRA into the next year, including your extensions, all the way up until October 15th of 2024 for a 2023 contribution. So that's going to give you plenty of time to look at your earnings for your business in 2023, decide if a SEP IRA is the right type of account for you, get it open, and make your contribution. We really just passed that October 15th deadline for last year's contributions. We had a lot of people reaching out to us and going into that, idea of, okay, I still do want to get a SEP open. I still want to make that contribution. How do I do it? So just keep in mind that it is still a hard deadline. So if you're looking at a SEP and you're not going to be looking at 2023's earnings until next year, that you're aware you have up until tax filing plus extensions, but you do want to talk to your CPA about that as well. The SEP contribution is $66,000 or a maximum of 25% of your compensation. It is 20 to 25% of compensation depending on your business and how you file. So make sure that you're talking to a CPA to have them help you, or a tax professional to help you calculate your contribution for your SEP IRA. It is $66,000 or up to 25%, the lesser of the two. So the calculation in there for you. The good news is you can still have a traditional or Roth IRA and make those contributions as well, along with your SEP contribution. So that gives you the opportunity to really max out the contribution that you're making into an employer plan plus your individual plan as well. I had a question pop up. If I have a second job with 1099 income and a regular W-2 income, can I invest in both the 401k up to $22,500 and up to 25% of my 1099 income into the SEP? You can potentially, because your $22,500 is your employee contribution, and your personal business, your 1099, is a separate business allowing for an employer contribution. So your employer contributions are separate. And so that gives you the potential. It might not be up to 25%. What I would normally recommend is just making sure that you're having a tax professional help you with those calculations. I have to double check. It's potentially you could make the full 25% of your self-employment income, but I do want to double check on that. So if you could send me an email, I could definitely get back with you on that. But yes, the potential is there that if you have a W-2 job, but you do have self-employment income, you can have an employer plan for your personal business. That will definitely work, and you can make those contributions. When I get to the 401k, we'll talk about, a little bit of an exception to having a solo 401k as well as an employer plan through your W-2 job. Now we're going to talk about a simple IRA, and the simple IRA again allows for larger contributions on an annual basis, different than a SEP IRA where those are employer only contributions. The simple IRA allows for you to make contributions both as the employee and the employer. A really cool thing about a simple, again, is that you do not have to have a formally established business to make both contributions, but you're wearing both hats. So you get to do both the employer and employee contribution. Again, talking to a tax professional to help you calculate those, but the employee contribution is up to $15,500 for 2023. You do get a catch-up contribution if you're over the age of 50 here. And then the employer match is up to 3%. It's 1 to 3% depending on how you set up this plan. Unfortunately, this plan did need to be set up in the current tax year by October 15th. So if you don't have a simple established, it is too late to establish it and contribute for 2023. But when we get into 2024, you still have the opportunity there to establish one for the tax year 2024. but the simple IRA for 2023 did need to be established by October 1st. The contribution deadline, as long as it was established by October 1st, is employee January 31st, 2024, and employer contributions are tax filing plus extensions, and that's where that October 15, 2024 comes in. So you did have to have the plan set up by October 1st, just to reiterate. But if you do have that plan set up, then you have still plenty of time to make both your employee and employer contributions. But please take note of the differences in the deadline here, because sometimes people think, oh, I have until tax filing plus extensions to make my employee contribution since my simple was already established, and that is simply not the case. Because the employee contribution should really be salary deferral, it should be made by January 31st, 2024, which really would basically kind of go along with your last paycheck of the year. So it really should be by the last paycheck of the year. But then your employee contribution, that 1 to 3%, you do have up until tax filing plus extensions if you extend, and that could go all the way up to October 15th of 2024 for the previous year. Now we'll talk about 401k and really more specifically solo 401ks, because those are the 401k accounts that we handle. The 401k, the solo 401k is a great account. A 401k just gives you the advantage of making larger contributions on an annual basis. So again, just to reiterate, SEPs, simples, and solo 401ks all go based on your self-employment income. So even if you have a current employer plan through your W-2 job, you can still have one of these for your self-employment income. And the solo 401k is going to allow, just as the simple IRA, it's going to allow both employee and employer contributions. So again, you get to wear both hats here. So you get $22,500 as the employee, plus another $7,500 if you're over the age of 50. And that's, again, employee contribution, or sometimes referred to as salary deferral. And then as your own employer, you get 20 to 25%. Those combined cannot exceed $66,000 under the age of 50 or $73,500 for those over the age of 50. And so this is really a formula, right, of calculating your earned income and your employee contribution plus your employer contribution. And again, it can't exceed $66,000. Our plan allows for a third type of contribution. So even when you're using that formula, if you had more in earned income, you could potentially put up to the limit in on an annual basis. I'm not going to go into that here because I do have a webinar coming up in a couple of weeks on solo 401ks where we're going to talk about calculating contributions and including the third type of contribution and how it works within the formula as well. So here, just know that you can really put a lot into the 401k up to $66,000 or $73,500. Again, it's going to be determined based on your earned income. So something that you're paying self-employment tax on in order to calculate those contributions. Now, if you have a W-2 job where you're contributing as the employee to your 401k, you can contribute up to that $22,500. If you also have self-employment income, you can still have a solo 401k, but that employee contribution is going to be per individual. So if you're maxing it out with your W-2 job, you can't also max it out with your self-employment income. However, the employer contribution is per employer, and so therefore you can still put 20 to 25% of your earned income into a solo 401k, even if you're maxing out your employee contribution with your W-2. I know that's a lot of information, so if you have specific questions on that, please let me know. But that does give you the opportunity to really max out contributions in an employer plan if you're self-employed, and you can still also have a traditional IRA or a Roth IRA and make contributions to those accounts as long as you're eligible. I had a question pop up. Can a sole proprietorship have a solo 401k? Yes, you don't have to have a formally established entity, and if you have an LLC and it's really just being used as a pass-through, you can still have a solo 401k. And yes, your contributions can be deductible. I see that question as well. Contributions can be considered pre-tax, so they would be deductible for yourself and for you as the employer, or Your contributions can also be Roth on the employee side. And again, I know the Secure Act 2.0 made some changes. Until the IRS gives us more clarification on reporting, those changes can't take effect. So we're still waiting for that. But currently, the $22,500 could be considered Roth if you elect that, or it can be pre-tax so that you can really maximize your deductions on an annual basis. I had a question pop up for those over the age of what the IRS considers retirement, which is 59 and a half. So if you're over age 59 and a half, can you still open and contribute to plans? You can, absolutely. You can still have employer-based plans. You can still have individual plans as long as you have earned income. So that's going to be very important. You do have to have earned income, but as long as you do, you can still open these accounts, you can still make annual contributions, and you can still grow those retirement accounts. So that is going to be something you're able to do. Okay, still covering solo 401ks here. Remember, these are the 2023 deadlines. For your employee contribution, if you have not set up your solo 401k yet, here is a specific deadline you'll want to remember. If you want to put that $22,500, and if you're over the age of 50, the additional $7,500 of salary deferral into a solo 401k, you do have to have the plan set up by December 31st. Once that plan is set up, you can make your contributions into the following year with tax filing plus extensions, but the plan does have to be set up before the end of the year. Your employer contributions are not subject to that deadline. So if you don't intend on making your 2023 employee contribution, again, $22,500, if you only want to make the employer contribution, then you don't have to worry about that deadline. It can be set up all the way up until tax filing plus extensions for employer contributions, but the employee contribution, it does have to be set up by December 31st. You don't have to make that contribution by December 31st, but you do have to have the plan set up by then. Okay, we're moving on now to education savings accounts. These are great accounts because they give you a lot of flexibility on what you can use the money for when it comes to education. So they're a little more flexible than like a state-sponsored plan. But unfortunately, the contribution limit is only $2,000 a year. But don't let that deter you because you can still self-direct it and grow it into what you know best. And accounts actually have a lot of flexibility on who will benefit from that account as well. So you can have an education savings account and designate it for a specific beneficiary. And when, for example, I have 3 kids, if I designate my son as the beneficiary of this account when he reaches an age where he needs to take distributions for education expenses, if he does not use this whole account prior to the age of 30, then I can redesignate the beneficiary as my next child and my next child and so on and so forth. So there's a lot of flexibility there as far as who can benefit from this account. These accounts can be set up all the way up until April 15th, 2024 for your 2023 contribution. And as we discussed before, please keep in mind that it doesn't go along with tax filing extensions. It goes up until the tax filing deadline of April 15th. That's very important. But you can open your account and make that contribution all the way up until April 15th for 2023. You just have to have all your new account paperwork submitted to us or postmarked and in the mail along with a contribution check by this date. Remember that there are no exceptions for bounce checks, checks lost in the mail, and wires not received. And that's very important because it happens every year. So if you're looking at these accounts and thinking about getting them open, give yourself plenty of time because these things do happen. Even if you file an extension, remember that your contribution has to be made by April 15th. Health savings accounts. I know that this is something a lot of people are really looking towards when they're setting up their family's plan or individual health, high deductible health care plans. Remember that you want to understand how contributions work for the HSA and that it's not, unfortunately, a way to self-insure. You do have to have a health care plan. It must be a qualifying plan, meaning that the plan allows contributions savings accounts and then you would be able to make those contributions. A lot of times people come to me and say, well, I don't know if my healthcare plan allows it, but I want to open this account and make contributions. And unfortunately, it just doesn't work that way. You do have to have a high deductible healthcare plan that allows contributions to an HSA in order to make those contributions. In order to make a 2023 contribution, your high deductible healthcare plan has to be established by December 1st of 2023. So we're coming up on that very quickly. And you must maintain that plan for the following 12 months for the 2023 contribution to be valid. So that's sort of how they do it, is you can still make that contribution as long as the qualifying healthcare plan is set up by December 1st. And as long as that is true, then you have up until April 15th, 2024 to make your 2023 contribution. And you can see the contribution is just going to be dependent upon whether or not you're setting up an individual plan and you have individual healthcare coverage, or if you have family healthcare coverage and therefore you can have an HSA for a family. I had a few questions pop up, so we're going to go back and talk a little bit about education savings accounts again. Can you have multiple education savings accounts for children and grandchildren? Each child that is the beneficiary of an account can have multiple ESAs, but the contribution is limited per individual. So for example, if I had an ESA for my child at Advanta so that I could self-direct it and I put $1,000 here, I can still have an ESA for the same child somewhere else and put $1,000 elsewhere, similar to the way traditional and Roth IRAs work, where the contribution is capped across the board per individual. How are ESA contributions treated for tax and pre-tax or post-tax? That's a great question. Thanks for asking it. With an ESA, contributions are made after tax, just like a Roth IRA, so you do not get a deduction for making that contribution. They grow tax-free and are distributed tax-free as long as distributions are for qualified education expenses. So that's super important, because if your designated beneficiary of this account reaches age 30 and you're not going to redesignate a beneficiary before then the distribution is going to be considered ordinary income and distributed to the beneficiary of that account. But if you're taking distributions for qualified education expenses, then those distributions are tax-free. We have another question here about health insurance and an HSA. Can he contribute to, my husband has the health insurance, can he contribute to the HSA? Again, that's going to depend on how the health insurance is set up. So if the health insurance that your husband carries is for the family, then he can set up a family HSA. So I hope that answers the question. If the plan, the health coverage is for an individual, then it's going to only be for the individual. Okay, Roth conversions. I know I had a few questions about this, so we're going to talk about Roth conversions, year-end strategies, and how that works. And again, I wanted to lead with accounts and contributions, because you're going to see how when we're talking about all of these different plans, a lot of them you're going to be making pre-tax contributions to, but that does not mean that you can't convert to a Roth IRA. So if you have a pre-tax account, you're going to see that those accounts can be converted to a Roth IRA, and many of them that can be done at any time. But just keeping in mind that doing a Roth conversion is going to be taxed as ordinary income to you. So Roth conversions, the deadline is December 31st, and a lot of times people come to us as they're getting to the tax filing deadline of April 15th, or maybe even with their employer plan up until their tax filing plus extensions. But unfortunately, a Roth conversion must be made within the current year that you plan on having the 1099 filed for. So Roth conversions are done in the current year. You have until December 31st. When we get to the end of the year at Advanta, we have a lot of Roth conversions form coming across our desks to get those deadlines in by, those conversions done by the deadline of December 31st. Be sure to talk to your tax professional before converting funds, because this is a tax burden to you. It's not paid by the IRA. A lot of times people say, well, just withhold the taxes when I do the conversion. And unfortunately, it just doesn't work that way. The amount that you're converting is going to be moved over to the Roth account in its entirety, and then you'll receive a 1099 as ordinary income for the year you convert in the amount you convert. So let's say that you convert 50,000 this year from your traditional IRA over to your Roth. In that case, what happens is that 50,000 will get moved to the Roth. It will generate a 1099. You'll receive it in January, just as you would any other 1099. And then you're going to take that 1099 to your tax professional so that they can help you with paying the taxes as if that 50,000 was an additional ordinary income. Sometimes I get asked, will that bump me up into the next bracket? It just depends. And again, that's where you want your tax professional assisting you with this. So if that 50,000 is going to bump you up, then yes, it is going to bump you up into the next tax bracket. And again, keeping in mind that it's considered ordinary income. Once you do a Roth conversion, it cannot be undone. So having your tax professional help you calculate the taxes and understand how the taxes are going to work for you at the end of the year is going to be super important, because if you do a Roth conversion now and then you get to the end of the year and find that you had a lot in earnings already and you really did not want to take that additional Roth converted amount into ordinary income, unfortunately, it's too late and you won't be able to undo it. So a conversion very simply is taking an account with pre-tax contributions and earnings, typically a traditional IRA, but it can also be the SEP, simple, or solo 401k or old 401k that we talked about, and converting it either to a Roth IRA or the Roth portion of your solo 401k to have the benefit of tax-free growth in the future. Electing to pay the taxes now on funds that are transferred over rather than have them grow tax deferred would be a big benefit here. But again, remembering that you're going to take that amount into ordinary income the year that you do that. The reason very simply that anybody would do that is paying taxes now rather than later. And so sometimes we'll see people say, well, this year I had a lot of deductions, I can offset the taxes. So this is the year my CPA recommended that I do a Roth conversion, and whatever it might be, or you can also convert over time. I think I have information on that, but if I don't, then I will go over that as well. So traditional to Roth conversion rules, Roth conversions must be done again by December 31st. That's super important. So I just want to keep reiterating that for you. There is no modified adjusted income limit for converting to a Roth IRA. Anyone can do it. And if you're not familiar with that terminology, basically, if you make too much money in a given year, you can't contribute directly to a Roth IRA. But if you wanted to do a Roth conversion, anyone can do it. You're not subject to those same income limits. The fair market value of any conversion is reported to the IRS on a 1099 for the calendar year in which the conversion is done. I know this seems really straightforward, and we're right now talking about converting cash, but we do also see people convert assets, and so we'll talk about that in a moment, and we'll talk about fair market value as well. The amount of the conversion is included in your taxable income, and it can bump you up into a higher tax bracket, but losses can offset the income from the conversion. You cannot convert for prior years once December 31st has passed. So sometimes, again, people will come to us and say, I just found out I had a ton of losses in 2022, for example. I'd like to do a Roth conversion for 2022. Unfortunately, it just doesn't work that way. And if your modified adjusted gross income is too high, and we talked about this, even though you might not be able to contribute directly to a Roth IRA, you can always contribute to a traditional and then convert to a Roth. And some people may be familiar with the terminology for that as backdoor Roth IRA. So why convert? Just if you're expecting larger returns on an investments in future years. So sometimes people will say, I think this investment is going to do really well. I want to convert the cash before I make the investment so that when I get paid back from the investment in a few years down the line, that it's going back to a Roth IRA. We have, the other idea that if you have a long time before you're going to retire and you expect it to be in a higher tax bracket, in the future, then you may want to pay taxes now. So if you're thinking, okay, well, taxes are going up, I have several years before I retire, I may want to do the conversion now, and that way when I reach retirement age and take money out of my account, it's already been taxed, and therefore distributions at the time of retirement would be tax-free. If you keep money in a pre-tax account, although again, it does have its benefits, when you take distributions at retirement age, it's going to be a pre-tax account and therefore taxes ordinary income the year you distribute. So that's a benefit to a Roth IRA or a Roth 401k. If the assets in your IRA currently have depressed values. So we're going to talk about converting assets and how that works. But if currently they're at a lower value and as time goes on, those assets are going to grow in value, then converting them now to a Roth IRA might be a benefit to you. If you have losses to offset the income from a conversion, this might be the year to do it. Sometimes people will do Roth conversions for estate planning reasons. So again, in Roth IRAs and Roth 401ks at the age of retirement or at the time of distribution, qualified distributions are going to be tax-free either to you or to your heirs. Again, they have to be qualified. We're not going to go too much into that today, but you know, if you're looking for your heirs to have tax-free distributions of your accounts, then a Roth IRA or 401k would be the way to accomplish that. And also, if you have the ability to pay taxes on the conversion this year versus years prior or years ahead, then this again might be the year to do the conversion. And remember, again, the tax is not withheld from the conversion. That is the biggest question we get. Another question I typically will get is, well, can I take a distribution from the IRA in order to pay the taxes at the end of the year? I strongly suggest talking to a tax professional about that so that you understand how the taxation is going to work, because you're going to get a 1099 for the amount you convert. You're going to get another 1099 for the amount you distribute. So you're going to see where there's going to be some overlying income amount there, and understanding how the tax will work on that is going to be very important. I had a few questions back to HSAs. I'll answer really quickly. Can a parent contribute $2,000 for the same child? Can each parent contribute $2,000 for the same child in an ESA? No, the contribution limit is going to be per individual beneficiary of that account. So again, if I open an HSA for my oldest child, then the contribution limit for that child is going to be $2,000 regardless of who's making the contribution. I had a question pop up about a health savings account. If I have an HSA through my employer, can I transfer money to self-direct? That's going to be a question actually for your employer. Some employers do allow it. They don't require that your HSA is with any one specific bank or company. And so you just want to check with them. But ultimately, yes, it could be, but sometimes it does depend on the administrator of your HSAs, because I know they're making contributions on your behalf at times. And if that's the case, they may want you to be at a specific bank or institution. But I have seen people move their HSAs that is sort of sponsored through their employer to Advanta. I had a question pop up about backdoor Roth conversions and still being allowed to do that through April 15th. The reality of that is, yes, you can make the contribution up until April 15th, but the conversion is going to be considered the year it's done in. So if you wait until April 15th to make your traditional IRA contribution, and then you want to convert that contribution to a Roth IRA, the contribution itself can be considered for the previous year up until April 15th, but the conversion is going to be considered for the current year. A question popped up about how old is too old to contribute to these various plans and what is the cost due to the Roth conversion. Again, that's going to be very specific to your tax bracket. And you're never too old to establish and contribute to any of these plans. Some of the plans will have requirements for required minimum distributions. So even if you can contribute, you may be required to take a small amount out every year if you're over required minimum distribution age, which is currently 72, and it's getting pushed back based on Secure Act 2.0 rules. But just keeping in mind that if you're going to do Roth conversions, the cost of that is going to depend on where your tax bracket is for that given year. I had a question on asking about discounts for the Roth conversion. I'm not going to cover that here, and that's not really something that Advanta can help you with. So if you have a tax professional that can help you with that, I suggest talking to them. I think the question is based on discounting the value of the IRA, but if it's also about, you know, offsetting the cost of the taxes for the conversion, either of those questions would be something you would talk to a CPA about. The correct way of reporting a Roth conversion is going to be on a 1099. That's another question I had pop up here. What about an 8606? The 8606 form is actually used to report non-deductible contributions to a traditional IRA. So if your earnings are too high to contribute directly to a Roth IRA, there's also the possibility, depending on whether or not you participate in an employer plan, that you may not get a deduction for making your contribution to a traditional IRA. And if that's the case, then non-deductible contributions are reported on an 8606 and basically record kept in that way. I had a few more questions. Just bear with me, guys, for just a minute. We had a question pop up here on paying taxes, estimated taxes quarterly to avoid a fine. That question is really more directed towards employers and not necessarily here towards individuals making contributions. And so if you have self-employment taxes, then that's really, I think, more specifically what you're talking about. Or it could potentially also apply for individuals filing extensions on their taxes, and that's really not something that I'm going to cover here and really is probably better addressed by a tax professional. Let's see, a few more questions popped up. If you only have passive income, then you're not going to be eligible to make contributions to plans with the exception of a health savings account. A health savings account does not require earned income to make contributions. Your passive income will still work there, but ordinary earned income is going to be true throughout any of the Roth, traditional IRAs, any of the employer-based plans. All of those do require earned income in order to make contributions, again, with the exception of the health savings account. I had a question pop up on what is a backdoor Roth IRA. If you would email me that question, I can definitely send you a webinar I did on backdoor Roth IRAs. Basically, again, the idea there is that your earnings are too high to contribute directly to the Roth IRA. And so when that happens, you can contribute to a traditional and then use this strategy for converting to a Roth in order to get money into the Roth IRA. So everything that we talked about for the Roth conversion applies to the Roth, the backdoor Roth IRA, where basically you're making a contribution, but then you're immediately typically converting it to a Roth IRA. I had a question pop up on whether or not you can roll over an entire old 401k into a Roth. Yes, you absolutely can do that. And again, just remembering that you're going to pay taxes on the amount converted. So if you have, again, in my example, 50,000 in that old employer plan, then you can roll it over to a Roth IRA and pay the taxes in order to do that. But that you're going to get a 1099 for that 50,000 in my example to pay the taxes at the end of the year. Another question popped up on Roth conversions. If you're over the age of 59 and a half and you do a conversion, can you withdraw the principal before the 5 years? Yes, you can withdraw the principal, and that's a good point. I do think I have that on one of my slides here. But whenever we talk about qualified distributions, a qualified distribution means different things for different accounts. For a Roth IRA, a qualified distribution is you've reached age 59 and a half, and that Roth IRA has aged for 5 years. With a Roth conversion, each time you convert money, it has its own 5-year aging. So that's very important. If you're going to convert over time, then when you do that, every time you convert, that new amount is going to have its own 5-year aging. If you're over the age of 59 and a half, you can take the principal or converted amount out without penalty, but your earnings are not penalty and tax-free, and that's going to be important. Once I set up a Roth IRA, can I contribute to the same Roth IRA in later years, or do I have to open? Nope, your Roth IRA can stay as it is. You can continue to contribute to it. So once you set up an account, you can contribute, and the 5-year aging is based on the first contribution. It's not, continually over 5 years unless you're doing Roth conversions. Remember, we just talked about how Roth conversions have their own 5-year aging. That is not true with your Roth contributions. Once you've made a Roth contribution, then your account, the clock on your Roth IRA has already begun ticking. So if you set up a Roth IRA 10 years ago and you've been contributing year after year, then your 5-year clock has already been completed. Now, if you do a Roth conversion, this new amount is going to be considered to have its own 5-year aging, and that will be super important if you're converting as you're reaching to retirement age. You want to make sure that you understand how those rules work. If you convert a partial interest in your self-directed SEP IRA to a Roth, do you need to have an appraisal done? Yes, we are going to get to that. We're going to talk about, oops, I'm sorry, kind of advanced the slides there. We're going to talk about how that works so that you're aware of how converting assets instead of cash will work. I'm going to move on. I do see a few more questions and I will get to those, but I also may answer them as I go on. So let's go back to the slides. I want to make sure that we end with, within our time allotted. So why sometimes people don't want to convert to a Roth IRA? If you're closer to retirement, and sometimes if you're close enough to retirement, you're actually expecting your tax burden to go down with retirement. So you don't have as much in earned income on an annual basis. And so, if you're close enough to retirement and you say, you know what, my taxes are going to go down because my earnings aren't going to be as high. And so I would pay more in taxes now to get to a tax-free account, and I'd still have to wait 5 years. Maybe that doesn't work for you now, especially if you're getting into a lower tax bracket. If the asset values in your IRA account are inflated or you're expecting some decrease in those values, it may not make sense for you. If you don't have cash available to pay the taxes for that year's conversion, that's going to be very important, remembering again that it's a tax burden to you and not to the IRA. And then if the income from the conversion may result in loss of other benefits. So thinking about child tax credits, Medicare premiums, and things of that nature. And again, this is where your tax professional is very important. Bring your tax professional in on this conversation and talk to them about the conversion and how it might affect you personally. Or if you want access to those funds within the next 5 years, and you're almost age 59 and a half, and you wanted the ability to distribute more than a specific amount, then again, looking at that and whether or not that's going to work for you. Again, you can convert over time, but if you're converting over time, every year that you do a Roth conversion, it's going to have its own 5-year aging. So that same $50,000 example, if I'm going to do that Roth conversion, and I'm going to do it in $10,000 increments, let's say, that so that I have the ability essentially to pay taxes on that amount over time. I can do that, but every year that I convert $10,000, that $10,000 has its own 5-year aging period. So keeping that in mind. So you can convert assets instead of cash if you have assets in your account and you want to do that, but you are going to need a qualified fair market value from an independent third party and documentation to transfer ownership of the asset. So, for example, if you have real estate in your IRA and you want to convert that real estate to a Roth IRA, you're going to have a certified appraisal done. You have to have the appraisal signed by an independent third party. And then you're also going to need to deed that asset to your Roth IRA. So remember, currently, if it's in your traditional IRA or SEP IRA or your simple IRA, that it's going to currently show with that IRA and account number. And if you're going to do a Roth conversion, now it's going to a new IRA account. And so its identity is going to go along with that and change over to the Roth IRA account, so Advanta IRA for benefit of your name and your traditional IRA account number, and now it's going to Advanta IRA for benefit of your name, Roth IRA, and the account number. So that's an important part of moving an asset in a conversion from a traditional or pre-tax account over to a Roth IRA. So that could be a deed, again, if it's real estate. It could be an assignment if it's something like an LLC or LLP. It would also need re-registration on the forms, again, to show that now it's in a Roth IRA. So qualified fair market value is something important to touch on here, because when we're talking about converting assets instead of cash, cash is very straightforward. You fill out a form, you do a Roth conversion, you're going to receive a 1099 for the cash that you're converting to the Roth IRA. But when you're talking about an asset, keep in mind that the IRS defines qualified fair market value very specifically. The valuation must be provided by an independent third party who is qualified to value that particular asset being converted. It can be provided by CPAs, attorneys, and appraisers, and all valuations must be done within a reasonable time limit within the last 30 days prior to the time of the conversion, so that accurate values are obtained. I'll give you an example of this. If you're looking at doing a Roth conversion and you say, what, I'm going to do part of a conversion in December and part of it in January, so that I am spreading that tax liability out over 2 years, you absolutely can do that. But just time your valuation properly so that you're doing both conversions within 30 days of the valuation given. So that's very important there. So here's just some notes on acceptable fair market valuations, real estate, certified appraisal. When you have notes, the fair market value of the loan or note would be the outstanding principal balance plus any unpaid interest. LLC corporations and partnerships, it could be the manager, president, or officer. Then an independent, if they value it for a Roth conversion, then it would need to be reviewed by an independent third party. And then if you have another type of investment that you're looking at converting, please reach out to us, because some of these are going to be very specific. But that just sort of gives you an idea, and just keeping in mind that when we talk about fair market values at the end of the year, if you're an Advanta IRA client, and I'll talk about that in just a minute, it's different when you have a taxable event. You must have a qualified third party giving a value and signing our form along with backup documentation for that, because it is a taxable event. So we talked about pros and cons really already, but everybody's situation is unique. Your taxable income is going to be unique, and sometimes it's even unique year after year. So keep in mind that when you're looking at doing a conversion, you want to look at that current year and whether or not it makes sense for you. Sometimes it's based on your age or projected returns, and also it could be based on how close you are to retirement. Work with your CPA or your trusted tax advisor to help you understand how that will work and if this is the right year for you to do that. And then again, you could convert over time, and you can even just simply convert in December and January to spread out that tax liability. Remember again, the deadline for this is December 31st. We'll go to a few more questions before we go on. If I'm 48 and retired with no income, what are my options for investing in a Roth? Is it only Roth conversions? Potentially. If you have no earned income, then you can't contribute directly to a Roth IRA. So if you have money in a traditional account, but you wanted to get it into a Roth IRA, then in order to do that, you would have to do a Roth conversion. A few more questions. I had another question pop up about employer, not really employer-based HSAs, but sponsored, I guess you could say, HSAs, and finding out whether or not you're allowed to move it. If you would just reach out to me directly and we can go over that more specifically, I'd be happy to help you and answer any questions. You don't have to liquidate an asset. We just covered that. So just making sure that you are, getting a qualified independent third party to value any assets that you might be converting. A couple more questions here, guys. I had a question pop up about stock holdings and if you can convert those over to a Roth? I think that question really is going to be better, asked to a brokerage account if you're looking at something publicly traded. But at Advanta IRA with a self-directed account, you can certainly choose the assets that you're going to convert to a Roth IRA. So if you have private stock with Advanta and you say, well, I have a piece of real estate and I have some private stock and I only want to convert the private stock, then yes, absolutely, you could do that. You can choose the assets that you're converting. You don't have to convert a certain percentage of each asset or anything like that. You can just convert a specific asset. I had some questions about some specific assets. Please reach out to me directly. I'm happy to go over that with you. If you're converting over 2 years, how much of the conversion will occur in year 1 and year 2? That's completely up to you. So if you had $100,000 in an IRA account and you wanted to convert $50,000 in December and $50,000 in January, you certainly could do that. Or you could do $20,000 this year and $80,000 next year. It's up to the IRA holder. What's the cost of doing a Roth conversion? If you don't have both a traditional and Roth IRA, or if you're setting up a brand new Roth IRA, it's a $50 account opening fee to get the Roth IRA open, but then we don't charge for the Roth conversion itself. It's just the account opening fee. So the last thing I wanted to talk about is account holder fair market values. If you guys have any additional questions, please get them posted into the chat box now. But basically, if you're an account holder, you already know that we do require fair market values every year. That value should be as of December 31st, and the deadline to provide those fair market values is March 15th of 2024 for this year's fair market value. We talked a little bit about what we're looking for as far as the value of each asset, but if you don't have a taxable event, then you don't necessarily need an independent third party for real estate. You certainly could get an appraisal. The fair market value as stated by the county property appraiser would work, or a market analysis. With notes, it's typically going to be the outstanding principal balance. And for LLCs, a balance sheet of assets and their values, plus a bank statement showing the cash balance from the manager. And if you're the manager of the LLC, that will work. Again, keeping in mind that the value should be as of December 31st, and that is not due to Advanta until March 15th, 2024. And we certainly do keep you up to date and remind you for those values. We want to make sure to get that every year. It is required by the IRS. Here's my contact information. I saw a few questions pop up I'll go over, but I wanted to put this out there because a few people had some very specific questions. I wanted to put my contact information on the screen so that you can reach out to me. The documentation needed, somebody asked about precious metals. Because precious metals are valued based on what they're trading at, we just really need you to complete a fair market value form, but we're going to grab those values, and that whatever the metal is trading at, that's what the converted amount is going to be. So I hope that's helpful to you. I don't necessarily see any other questions, so I'm going to wrap it up. I'll give everybody just another minute to get any questions posted. But if anybody has additional questions on their specific situation, please feel free to send me an email or give me a call. This webinar was recorded, and so you are able to go back and review it if you wanted that information. And don't forget, the handout is attached. These slides are attached in the handout box of the navigation. With that, I'm going to end the webinar. I thank everybody for joining us, and I hope to hear from you all very soon. And again, I have a webinar coming up on 401ks in just a couple of weeks. I hope you can join me for that one as well. Thank you.